Good morning, and welcome everyone to the Global Capital Markets panel at the 2019 Milken Institute Conference. I'm Allison Mass, Global Head of the Financial and Strategic Investors Group at Goldman Sachs. So what we want to do on this panel is address a broad array of geopolitical and economic topics, and I'm really delighted to be here today and hear thoughts on these issues from a fantastic group of experienced industry leaders. So diving right in, let's start with the geopolitical environment and its influences on the market. One of the pressing issues of our day is the rise of nationalism and populism. So, Sir Michael, as head of a multi-strat asset management firm based in London, I'd like to start with you. What are the underlying drivers of these related trends, and what are near-term and long-term economic implications for them?
Okay, well, again, thank you very much, and it's such a pleasure to be here this morning. Look, my view, very clearly, that this has come from the global financial crisis. Remember, what have we done? Simplistically, but what have we done? We've borrowed money from our children and brought it to us today. That's basically given us the situation where it's increased the Gini coefficient, increased the amount of disparity in our society. And the reality is, remember, if you have no capital, why be a capitalist? That's the real problem we've got here. A little bit simplistic, but if you have no capital, why be a capitalist? And the logical response to that is to be a socialist, a nationalist socialist, or a Trotskyist socialist, or whatever, or at the very least to be a governmentalist. So we've got a situation where this has led to populism. Yes, there is a view that the liberal elite has let us down, has let the world down, that there's a disparity, that people will not be better off in the next generation than they are today. And we have some really interesting phenomenon. And the reality is the populist voting share is increasing all over the world. If you pull up slide 13, 1.3, you'll see what is going on there. Slide 13, if we're waiting for that. But again, let me just talk through that. It is increasing all across the world. And what is that giving us the opportunity to do? It is providing a very interesting trading investment opportunity. You need to understand what's happening here. And again, if we go to it goes across the world. It's a global phenomenon. Latin America, Europe, US, for that matter. And if you go to slide 14, the next slide, on 14, you'll see that it is different country by country. It is a global phenomenon, yet country by country, it is different. And that is the intriguing thing about that. So if you focus on Europe, which is the next slide, slide 15, there we see a significant divergence of populism, whether it's in Italy, where again some really interesting things to trade around, and it's quite an interesting play there. Obviously, we have Brexit, we have all sorts of other things going on, and the intriguing thing about this rise of populism is it leads to a policy dilemma, a policy vacuum. And frankly, it is one of the reasons what allows China to be as effective in the world. And I'm not going to talk more about China, but that is another massive theme and another massive view that comes out of the populist agenda.
So thanks for that. Following on, Mark Machen, as head of CPPIB, which is one of the largest pension funds in the world, you set very ambitious targets for investments in emerging markets. With all of the geopolitical and trade tensions going on today, could you please share your views on China and how those tensions have changed your near-term investing outlook in the country, if at all?
Yeah, thank you. So I think the key on China is huge, which we all know. It's massive population. As a component of Asia Pacific now, Asia Pacific is now 2/3 of the global growth. It's 60% of the global workforce. It's 50% of the population. It's 50% of fixed income of fixed investment in the world, and then with intra-regional trade is just increasing. 70% of container traffic in the world is in Asia. China's a key component of that. China today is pushing towards its mid-teens percentage GDP. It will be 20% of GDP in the world by 2025, and if things grow in a straight line, it will push towards 25% of GDP by the mid-2030s. So just from pure economic size, massive, so we have to pay attention to it. Second thing is markets. Market today, as we know again, the equity market is already the second biggest equity market in the world. Bond market, by some measures, is the second or third largest market in the world. So, government bond market is second largest bond market in the world. So these are huge markets. So the question for us is, what do we need to do about that? One of the things that we have the flexibility on is we don't need to worry about index inclusion. So it is, I think, a positive thing for the economy and for markets that MSCI has taken the lead in moving towards index inclusion. Other indices are following. Bloomberg indices are now including on the fixed income and bond side, which is hugely important for many more investors. So there's much more that's investable now in China. In fact, the vast majority of those markets are now investable for a normal investor, although the indices are only including a small weighting today, which will gradually ratchet up over time. I sort of have, from a fund's point of view, I have sort of mixed views about that because we already had access, and it would be nice for us to continue to mature our investments and get more scale in those markets before everybody can get access. We already had QFI, QDII, we had other ways of accessing those markets. But I think, so what does all this mean, and where is China going? It's big, it's diversifiable into, and I think increasingly investors are having to look at it. The way we look at it is really two simple ways. One is it's a big market that you can diversify into. And if you look at discount rates, risk premia, there's pretty low correlation with the rest of the world. So it's a big market you can diversify into that is uncorrelated with other markets. And that's something that most investors should look at. Second thing is there's a lot of inefficiencies. A very considerable amount of the equity market is still retail-driven, inefficient retail-driven. Considerable amount of the bond market is just traded by banks, not really traded. So there's huge amounts of inefficiencies. So there is an opportunity for excess alpha over time as well. So from both of those reasons, that's why we're diversifying into that market. We also have the ability to invest in private assets as well, and that's a whole other story I could get into. I think just to touch, before I finish on China, on the risks. There's lots and lots of risks. I think in the short term, there are 2 or 3 major risks, which are inappropriate regulation. So I'd say there is the risk. Last year, there was an excessive and simultaneous clampdown on the shadow banking system and deleveraging the economy. Both great things to do, but doing them at the same time had the unfortunate consequence of really starving the private sector of capital in China. Second thing is the trade tensions. I think markets right now seem to be pricing an almost given that there will be an agreement with the US on trade. We all hope there is, but there's more risk to that, certainly in the medium term than probably markets are pricing. And if there wasn't a trade deal, then I think, and if tariffs went up to 25%, it would have a profound impact, not just on the China markets, but I think the global economies. And then I think there's the risks of tensions with other countries around the region as well. The other big one is debt. The fact that debt, as Sir Michael just mentioned, globally is 250% of GDP. Similarly in China, it's at that level. And if you look at the local government financing vehicles, they have 50 trillion renminbi of debt. Plus, there's a bunch of other vehicles that have another 50 trillion of commitments on top of that. So that's a huge amount of debt and obligations that somehow needs to get paid or restructured or pushed through the NPLs, the banking system. And then finally, I'd say in the long term, two major risks, which are demographics. The workforce has already peaked. The overall population will peak in the next 10 years. And so there's a big demographic decline, almost on the same curve as Japan. And then finally, there is the political succession process as well, which I think will be a big issue.
Can I say something on?
Thank you. Michael, you said you wanted to.
Sorry, I didn't mean to, to bump in. I was trying to say sort of voce. No, but Mark as always cuts to the chase very, very well. There's a massive opportunity there. But the point which I wanted to add was that this fits very well, very, very well with their geopolitical thrust. And part of that geopolitical thrust is to become a competing reserve currency to the US dollar. And to be a reserve currency, you need to be three things. One, a unit of trade. They're the largest trading nation in the world as we speak. The unit of trade they are. Store of value, we'll see, but I think that they've got a good chance to be there. But frankly, they need to be investable, which is what Mark has spent time now talking about. And for it to be investable, it does need to be open. So as part of the move toward being a global reserve currency, those three things are there, but especially the fact that they're opening themselves up to be an investable currency. And the other thing probably is to run a current account deficit. And I don't know if people have noticed, but in the last quarter, they've started running the current account deficit. And it's actually quite clever the way it's being run. And of course, if you're supplying the renminbi to the world, or I guess it sort of looks through the dollar, through the lens of the dollar at the moment, but if you run that situation, you can actually have you do actually need to be investable. And I think there's a massive opportunity there, as Marcus has outlined.
Thank you. Let's transition a bit to more of general macro environment around the world, particularly in the U.S. Mark Attanasio is head of a direct lending platform. You need to be attuned to the impact of the central banks and the impact they're having on liquidity. So the year's off to a good start. How do you see that progressing throughout the rest of 2019 into 2020 in the U.S.? And where do you think we are in the cycle?
So, Alison, I'll actually start with, I think, slide 9, just as a backdrop to play off what Sir Michael and Mark said. We have a slide that shows what our investors voted in the last conference, our last investor conference in October, as to their largest risk, and that would be geopolitical. 50% of our investors were worried about that. At Crescent, we are exclusively lenders, effectively, and so we're perpetually nervous, and we try to look at things we can control. We can't control geopolitical risks. Number 2 risk our investors highlighted actually was Donald Trump at 18% of our votes, and we all know we can't control the president. So we focus on number 3 risk was global liquidity and the impact of the central banks. That we think we can at least measure. And today it appears, especially after several rate hikes in the United States, but it appears as though the central banks around the world have our backs when it comes to taking risk. Virtually, in Europe, United States, Japan, there's accommodative policies, somewhat executed in different ways, but accommodative policies. And so the environment is going to be such to still try to squeeze whatever's left out of this growth cycle, to squeeze more juice out of the orange, so to speak. We've been concerned since 2014 at Crescent that the cycle was coming to an end. Here we are in 2019, and we still feel you have at least another year to go. And we have the benefit of looking at flash numbers from private companies, middle market companies, which often give you a better indicator of where things are going globally. Recently, we've done going private transactions not only in the United States, but in Australia and New Zealand. And I can say things are pretty good there. And in the Eurozone, obviously slower, but with accommodative policies there, maybe engineered differently in how they're making incentives to banks to make loans, we are still finding growth in niche businesses in Europe, especially in the developed countries in Europe for what we do. So measured caution, but I'd say for this year, still growth and still okay.
Thank you. Joe, you're also heavily invested and focused in the credit space. Do you agree with Mark's assessment of where we are in the cycle?
You know, I think it's a great question, and I think one of the ones that we as investors all collectively have to be thinking about. On slide 32, I don't know if we can put that up. One of the things I chair our risk committee, and this is something that we use, and I'd like to share with you all as a way to put things in perspective and really try to take the emotion out of where we are from a kind of long-term value perspective. And I think maybe to answer the question of where we are, you kind of look at maybe where we were and then where we're going. In the peak of 2018, for example, if you looked at equity markets, and let's use the equity market in the US equity market as a broad measure, PEs were close to the 90th percentile. And then if you look at credit markets, let's use high yield in the US, also around the 90th percentile in peak of 2018. And what that informed us when we were thinking about it from a top-down perspective was that valuation was actually quite stretched. And then turn the clock forward to end of December, and things had changed dramatically. Growth rates had slowed. But if you actually looked at the rate of change of valuation versus the rate of change of growth, it was actually maybe too far, too much. That was our perspective. And I think if you looked at where PEs were, they were in the low 30s, and also in terms of where high yield spreads are. So now, today, we're actually in the 74th percentile, give or take, in the US equity markets from a PE perspective. And then in credit spreads, actually we haven't snapped back that far. So we have had a big recovery, but maybe putting it in perspective over long periods of time, we're not necessarily at the peaks that we were in 2018. Okay, so that's one way to look at things. But I think from our perspective, the maybe even more interesting question is, what do you do? And that's kind of where I think we spend a lot of time thinking about from a bottom-up perspective. And slide 33 is actually, I think, where we've tried to take our focus, which is to focus more on event-driven, opportunities, idiosyncratic situations globally. And default rates have been low, and Mark kind of made the point, it hasn't been a really high default rate environment, yet what we've seen is under the surface, there's actually been a lot of sort of disruption, right, amongst a lot of industries, retail, energy. We've found great investments globally. For example, Oi in Brazil was the largest Brazilian default in their history. We led that restructuring. We found some great investments from a distress perspective in financials in Europe. In North America, Puerto Rico has been a tremendous opportunity. 21 different boxes to invest in, $70 billion worth of debt, completely messed up. In fact, if you thought back to what my sort of overview was from that perspective of where we were in December, the market had gotten very dislocated, and in fact, we were looking at Puerto Rico, and that situation, which was very, very event-driven and was on a process, sold off with the rest of the market, even though its situation was actually improving. It gave us an opportunity to invest more. So, I think from our perspective, we try to find things that are going to be a little bit less tied to some of the kind of these big macro risk-on, risk-off moves to take advantage of opportunities that, from a bottom-up perspective, we can make money on.
Hey, Joe, I want to stay with you for a minute. The loan market has doubled in size since 2007 and has become a focal point for regulation. So what are your concerns for the market, and what's different about loans this time versus the previous cycle?
Yeah, so that one's a great topic. It's caught sort of headlines. In fact, it's caught the Federal Reserve's attention. Slide 34, if I might kind of just hit you with a few stats there. We've been talking about this for a few years. The rating agencies have caught on as well. Really three areas of concern broadly when you take a macro look at leveraged loans. Recovery rates from where they were before look different. So 20 years ago, you had 40% subordination. You look like you have 20% subordination now. That means broadly you should expect same cycle, lower recovery rates. Cov lights have been talked about a lot. So in 2007, there was about 17% worth of Cov lights in the leveraged loan market. They're 78% now. So just from a lender and and debtor perspective, the conversation's different. And then from a leverage perspective, you're also seeing leverage creep into the system like we had in 2007. So we're at 4.4 multiple on senior secured debt and versus 3.6. So that's a bad equation for where we are in leveraged loans. But if you turn to the next slide, page 35, some of this has already been being priced in, right? So this isn't sneaking up on the market perfectly. If you look at where loans are pricing relative to bonds, they used to price materially tighter than bonds. And sometime after the financial crisis, if you actually look at the relative spreads, they've actually come in, and you're now seeing what might seem unusual on the top from the surface, that loans actually are pricing around the same spreads as bonds. Now, some of this is because loans are floaters, and there's different demand for floaters in a very, very low interest rate environment that we're in today. Some of it's also composition. There's been some changes. But I think some of it's also some recognition and change in the credit risk. But I think that the takeaway I have from this and from a manager's perspective is the expectation going forward is we're going to have more volatility. And I think to invest in loans, using the same sort of passive approaches or counting on senior secured aspect of bank loans isn't going to work out the same. And credit, sort of active management is going to be what really differentiates, the ability to really take advantage of this asset class.
Thanks. We have a lot of topics to get to, and I want to talk about market structure next. But before we do, Elif, in our conversations about China, I'd love to get your perspective from a capital markets point of view about the gradual opening of the markets, and if you can give us a brief perspective on what you're seeing.
So we've seen a gradual opening of Chinese financial markets over the last 2 to 3 years, as led by the Chinese government and PBOC. A couple examples include restrictions that are lifted in foreign ownership of securities companies. We are now able to own 51%, as well as such restrictions in asset management and life insurance companies. Those restrictions will be totally abolished over the next 3 years. Similar opening up in the automotive sector, where alternative energy providers, the electric cars now, the foreigners could own 100%, and the same thing is going to be applied to commercial auto manufacturers as well as passengers over the next couple of years. Something similar in oil and gas, wherein downstream fuel distribution, foreign ownership has been lifted. Also, from a stock market perspective, you'll recall a couple years ago, there's been the Shanghai-Hong Kong Stock Exchange that has been expanded to Bond Exchange, Bond Connect, as well as Shenzhen, Hong Kong. And this year, China has announced intentions to connect Shanghai to London and Shanghai to Deutsche Börse. So clearly a lot of intention. But to put all of this in context, foreign ownership of Chinese A shares is 2.6%. This compares with 39% in Korea, 30% in Japan, 21% in the US, and 20% in India. So still room for growth.
That's great. Anyone else want to weigh in on the opening of markets in China before we switch to next topic? Any other perspectives? Okay. So now moving to market structure, we've seen a migration of capital from public markets to private markets over the last 20 years. If you can put up slide 43, please, for a minute. The left hand of the chart, when it goes up, you'll see, shows the absolute number of listed US companies has decreased over the last 2 decades. By the end of 2015, you see the number stands at half of the 1997 count. We also see the percentage of US taxpayers participating in the stock market drop off over the last 20 years. So Mark Machen, I want to ask you, you allocate capital across both public markets and private markets. Is that shift mirrored in your own capital allocation? And if so, what's the rationale for that shift?
Yes. So if you look at our assets, if you just look at level 2, level 3 assets together would be about 65% of our portfolio, level 3 about 50% of the portfolio. So there's one way of looking at how much private we have in the portfolio. And I think probably a lot of our peers are quite similar. There's been an inexorable rise of the amount of private capital that we've all invested in. And that's broadly, so that's across private equity, that's across infrastructure, that's across private credit, real estate, so real assets and private, other private capital. Now, we like the different diversification potential of these different types of assets, but private equity is very similar to public equity. And as we look through it, sort of underlying equity, we think that while valuations got very stretched in private equity compared to where they used to be, there's still, when we look at our sort of long-term return expectations and what we see in the market today in private equity, there's still, some opportunities there in the US and Europe and in Asia. So it's an area that we will likely continue to invest in. I'd say on the other real assets areas on real estate and infrastructure, they're pretty highly competed, and there's really not much juice left in those markets at the moment for us. So it's something that we're struggling to find good opportunities. So I'd say we're quite happy, and one of the reasons why we're quite happy with this is because of we have very, very dependable money. It's very long-term money. It can weather the illiquidity in a downturn, and we have a big liquidity buffer in a downturn, which I'll come back to. Second point I'll make, just on the this sort of alarm about the fall in the number of public companies. We certainly want to see good functioning public markets, but I think it's a little bit overdone just to look at the number of those companies in the US market. For example, that's just looking at the US. If you look at the world, going back to China again, China had no listed companies 40 years ago, and now has 3,500 to 4,000 listed companies. Same in many other markets around the world. So when you look at the number of listed companies in the world, it's gone up dramatically in the last 40 years. So yes, it's gone down in the US, but it's gone up dramatically overall. Second, you look at the amount of capital that you can invest in versus GDP. And the US is now at almost record high, 150% of GDP. So as a percent of GDP, it's pretty high. Third thing is if you look at it relative to the dry powder in private equity. Dry powder in private equity is sort of 1.7 trillion or so. But global public markets, 80 trillion. And if you just look in the US, there's 2 companies are valued more than all of the dry powder of private equity. And then I'd say the final thing I'd say on this point is that back in the day when a lot of small companies were going public very, very early, arguably a lot of those companies were too early for prime time, too early for public market. The fact there's been more growth in private capital to nurture these companies for more years before they actually go to become public, not necessarily a bad thing. So I think it's a little overplayed to get just alarmed by that one statistic and that declining graph. Final thing I'll say on this topic on the rise of private is I think people like us need to be super, super careful of the next downturn. Because when the next downturn happens, when the market drops a lot, we're going to have all sorts of problems in the private assets. They're all going to be stretched. They're all going to need more capital. And at the same time, we're going to need liquidity for obligations. And I think pension funds and sovereign funds and endowments around the world need to be super careful to not lean in too much on the private side and not to rely on the fact that the public stuff will be liquid when you come to sell it. Because when you're trying to sell that stuff, everybody else will be trying to sell it as well to fund their obligations. There's not much inventory in many of these asset classes, as we know. We saw the behavior, the gapping in December in a number of these markets. And I think you're going to find that risk models could blow out very quickly on the public side and trigger more events. So I think people need to be super careful and robust and massive liquidity on the public side and expect there to be a lot more gapping when they come to sell stuff to fund all the problems they have on the private side. So I'll leave it there.
No, it's a very balanced perspective. Elif, on the public to private side, you've noticed that this shift is an overlooked element of the focus on ESG. So what do you think of the long-term implications of that shift in the global society?
So private capital markets are a very important part of the global capital flow. Today, as much primary capital is raised in privates as in public capital markets, both especially in the US and in Asia Pacific. And there are some socioeconomic and ESG considerations that we think need to be thought of. Firstly, there is the concept of wealth distribution. Public capital markets, public equity markets, are an equitable and democratic way of wealth creation. Through pension funds, through insurance schemes, through retail investors and ETFs, you have large parts of the population that can participate in public markets. So far in private capital markets, participation has been a little bit more narrow. You've had the venture capital firms, financial sponsors, and LPs. So the wealth distribution and contribution inclusion is one important characteristic. The second one is governance. Public capital markets have proven themselves in terms of disclosure, accountability, and oversight, which are, again, important social responsibilities of capital. I think private capital markets are nascent, and they are yet to prove themselves when it comes to the governance elements. And the third, potentially most important aspect is sustainability. In the 1990s, on average, venture capital-backed private firms stayed private for 5 years. Since 2010, they are staying private for 9 years, which means a lot of the growth and the returns in these companies are taking place when they are private. And potentially growth is a little bit less after they mature and become public. When you think of the sustainability of the world at large, and you think of a world of self-funded retirement, I do think we have to think of return implications, long-term return implications of public capital markets in the rise of privates.
Thanks. Another big shift in the public equity markets is, in particular, the move from active to passive management, which has largely been characterized by short but dramatic spikes of volatility. So, Michael, it would be great if you could talk about the implications of the rise of quantitative investment strategies and passive investment strategies like ETFs.
Certainly, if you call up slide 45, slide 45, again, you'll see that this is a much bigger trend than we've seen for a long while. The reality is, what this has meant is that the market, if you're trading it, is actually overwhelmed by the passives on a longer-term basis. Because what happens on the first day or so of bad news, the active guys will sell out. It'll push the price down, and then a lot of the passive, which is again, and remember, machines have no fear. They don't have anything aside from going backwards. They have no valuation per se. The only thing they're looking at is trends, and trends to the mean, whether it's trend to volatility, trend to price, trend to momentum. They will actually drive it back. So again, it's one of the frustrating things if you are running a active trading strategy, where that is. So what that does mean, if you are seeing a valuation, it'll actually change pretty darn quickly. And it goes back to the point which was made earlier. These passives have done things like they've distorted the bond market valuation versus the loans. I mean, there's no reason why the loan should be trading through. Say again, why a bond should be trading, a yield should be trading through a loan yield. The driver of that is the fact that there's a massive amount of passive money going in there that's not looking at value, and that's one of the things that's there. But what is interesting is a lot of these ETFs, a number of them are driven off ESG. Again, that does, I think, drive valuations perhaps for the good in terms of making sure that good companies with good ESG have got tighter valuations than they are. So it's not necessarily all bad, but there's no question that the machine will have no fear, and it basically means that it'll actually push things to different levels. And it is an interesting market to trade in, frankly. I've been trading since 1982, and it is different now. You can actually see the algos pushing against you if you're trying to execute a trade. And frankly, it's one of the reasons why I can imagine people are very happy to live in a lower volatility basis of a private world without having to worry about the volatility that comes out of the ETF.
So Joe and Mark, are you seeing a rise also in the passive investment strategies in the credit markets?
I think there's a rise from Crescent's perspective, and again, we're looking through a little different lens that a lot of folks are here. We have 2/3 of our business is making private credit investments, and so a lot of what you see in terms of excesses in the market or challenges are things that we can, as I alluded to earlier, control. You see some larger public bond managers from our vantage point using ETFs to add assets when they can't otherwise add assets. For our clients, I talked to one of our high yield portfolio managers who every week will either speak to an existing client or a prospective client. No one has really broached with us, why would you invest with Crescent or with an active manager versus a passive manager? And I think one of the reasons is that on the passive side, so far, you still can't beat the benchmarks the way you can with equities. So I think only, CNBC did a study last year, and I think 36% of active equity managers were able to beat a passive benchmark, whereas in intermediate bond managers, it's 70%. I've seen for high yield bond managers, 80% of us beat passive indexes. So there's really not an advantage yet to going passive. The other, I think, technical point is that there's one CUSIP for an equity, and for a particular company, there'll be several different bond CUSIPs. And so one of the benefits an active manager has is to pick the proper tranche of security to invest in, and not, you've got, in many cases, 5 or 6 choices of loans to invest in or bonds in a particular company. And the trick is to pick the right one. So in the risk environment that Joe described, we are now moving more senior and shorter in duration. Equities, it's a binary choice. You pick the stock or you don't. So for now, the ability to control, credit's a good place to be to control your destiny relative to some of the challenges you see. And for right now, we're not worried about ETFs. They do spike volatility, and that some of the things, Joe, you're talking about that you take advantage of, and we try to take advantage of. The ETFs create more volatility in the markets, and that's, for patient investors, that's opportunity.
Yeah. Can I just...
Joe.
I just sort of, maybe to compliment Mark and Sir Michael, the sort of passive rise is great. I mean, because it does a few things. One is, if we can't add value by finding other things to do that the passive is doing, then I think that's pretty sad. So I hope we can. It does create great opportunities, for hedging. So September 2018, I think HYG was one of our largest shorts in our book. The spreads were at 305. Thank you, ETFs. That was great. And then there also, when you look at, I can give you lots of markets that have not yet been passivized or haven't been active, and that's where we go. So we're going to go to where the opportunity exists. It's going to be things like they're going to be sort of out of that sort of world, and that's where the relative value, and we're going to earn sort of better returns and be able to capture value. Emerging markets, distressed, structured products. We see this all over the place. So for at least now and maybe for quite some time, this isn't a bad thing to us. It's actually a good thing. It's creating, I think, more fragmentation. It's creating places for us to be able to kind of capture relative value and quite often be able to hedge better than we maybe could have even 10 years ago.
Yeah, and to be clear, these passives do not take away our ability. In fact, as you say, Joe, they add to our ability to take idiosyncratic risk and potentially hedge that risk as well, which is the exciting piece about it. And again, as a recipient of funds to manage from sovereign wealth funds all the way through to pension funds, frankly, to individuals, there is a barbelling going on. People will seek their beta at a very, very small return, and yet we'll be paid to do what we do hopefully well at a better rate. And I think that's a healthy part of the market, I think.
Exactly.
So yeah. I want to pivot a little bit more towards general technology and the disruption we're seeing in market structure. Much of it has been focused on the buy side. So Elif, what roles do you think technology and data analytics have to play on the sell side, both in the context of relationships and in service in capital markets?
Thank you, Alison. A couple points come to mind. First of all is cost. As the buy side has moved to more ETFs and more passive, we need to replicate that. So we're using robots, we're using robotic process automation, and other measures to be able to offer cost-effective service to our clients. So cost is an important part of it. The second part is speed. In 2000, it took 25 seconds to execute a trade. Today, we execute 1 million trades in a nanosecond, in the blink of an eye. So our pipes need to be faster, a lot of investment going into speed of delivery. Thirdly is the use of data analytics and AI to serve our clients better on the sell side, to use the relationships and the trust in the relationships with data. So we're working on projects like Demand Predictor. Within the context of equity capital markets, we have a model that predicts who will show the best demand, highest demand in an equity offering, whether it's an IPO or a follow-on. Or we're working on things like Day Finder. Can you assign a temperature rating for any given day to decide whether it's a good day to launch a deal? Other things, can you predict or forecast using data how a stock will perform after the IPO, depending on where you price it versus the demand book or the composition of the allocation? So there is a lot that's going on in data science and machine learning that we can use to augment our relationships and move from a relationship only to a relationship with data type of model. Also, something like the Uberization of financial services is happening, in our opinion, which is creating of platforms. Bank of America is a founding member of an industry-led consortium that uses technology to improve communication on new issues. The idea is, can we have a seamless issuer to investor new issue experience? We've started this with investment grade, but potentially the applications are across asset classes. So it's the concept of almost investment banking as a service. So technology is very much affecting many metrics on the sell side.
I was going to ask you if today is a good day to launch a deal.
Yes.
Yeah, you heard it here. So technology is also having a disruptive impact on investing, particularly for long duration investors. And Mark Machin, you probably have the longest term investment horizon of any of the panelists. And I know you've thought at CPPIB about greater focus on thematic investing, particularly around mega trends. So how do you think about long-term investing in an environment that's ripe for disruption?
Yeah, so I think that there's offense and defense on this. So I think everybody here recognizes the increased pace of the acceleration of disruption. And so long is gone the time where we could invest in a piece of infrastructure, think we're going to hold it for 50, 60, 70 years, and nothing's going to happen in the environment to it. So whether that's electricity transmission or gas transmission or even a toll road, these things, there's going to be technological change that is going to change the outlook for these assets over time, and it could happen much more quickly than we had anticipated. So we need to understand these trends, and so we're playing defense and trying to figure out what these trends are, how they're going to impact all this stuff that we're holding in our portfolio in the longer term. And then there's the offense of trying to find interesting opportunities in these areas to invest in. So we established a group a few years ago called Thematic Investing to try and exploit these long-term themes. These are not secret themes. These are not themes that other people haven't seen, but they're ones that it requires a fairly long-term hold to actually exploit the value in them, and some fairly detailed analysis to get down to find where the value is at any particular moment. So, for example, just the trend of data analytics and data to value, automobility, the move to electric vehicles and autonomous vehicles, energy disruption, how that's changing, demographics, the aging baby boomers, and then the power of the consumer in middle class and in emerging markets. And then the environmental and climate change shift, which I'll come back on that one. a couple of highlights on, for example, automobility. We look at our toll roads, we look at what might happen with autonomous vehicles, the positives, the negatives with autonomous vehicles. And we want to understand the uptake of these vehicles. We actually are more optimistic than market and most people on the uptake of autonomous vehicles. We think it's going to happen faster than most consultants and commentators think. We've invested in a number of the private autonomous vehicle companies like Aurora, like Zoox, and we're also investing in some of the charging companies and some of the sensor companies like Aptiv to understand this environment. And so I think probably net is probably a slight positive for toll roads in the longer term, and then ultimately you'll be able to compress more cars, be more efficient transport over these toll roads. But something we got to watch very carefully what that will do. It's clearly a negative, probably a negative for your parking, depending on where your parking is, because your car will be able to go off and park somewhere else, but you're probably still going to need your car in some type of vicinity. So I think there's quite micro in parking as well. Just on the environmental and the ESG stuff, I might just touch on that for a second, because it's something that we focused on. There's obviously a huge amount of effort around the world to push companies and to have better environmental, social, and governance responsibilities, something we've been doing for many years, focused on a whole number of areas. Investing in it and actually creating alpha from it, very, very difficult. And so it's something that I think most ESG, or almost no ESG fund actually creates any alpha. I think some of the ESG stats are just so noisy. It's almost useless to use. You'll have one provider that will have Tesla at the top of the ESG stats, and one that will have Tesla right under the bottom of the ESG stats, depending on a whole range of governance and fuel and efficiency, and so they're just virtually, I wouldn't say useless, but they're virtually useless today at the stage they're at right now. So you have to build your own database, proprietary database, figure out what really matters for each company, each sector, and that's laborious, takes a lot of work to actually use that data effectively, but it's something that we think is important for long-term holds. One particular area we focused on is gender diversity on boards, which we think is an important issue. I know I'm drifting off technology here, but I think gender diversity on boards is something we've done a huge amount of proprietary research on. We've done a meta-analysis of 100 external studies. We've done our own study of 3,800 securities around the world, and we think there is a positive correlation between gender diversity on boards and long-term value creation on boards. So it's something that we've become more active on pushing in with our companies. So that's another theme.
Can I just add something with Mark? It's interesting. Mark comes up with Tesla. We obviously use ESG in our process as well. The weird one is Tesla. You're quite right, Mark. It's either at the top or the bottom. Very, very interesting. I think it's got everything to do with how disruptive that company is. Notwithstanding the G does sometimes make my eyebrows raise, but that's another story, right? But the point is that is such an incredibly innovative and disruptive company. And look, there is a major theme here going on. And if I might call up slide 12, but as we're calling up slide 12, we are in a disruptive world, and Mark is right at the heart of it. And his investment horizon is very, very exciting. The interesting thing about this is that you think about the Marxist view of the world: labor, capital, land. We now have data as the fourth tool of production. Labor and technology is the fourth tool of production. And that is in a world where we've got a massive market volatility around politics. And Mark's point is you invest in a toll road for 50 years, and let me tell you, 30 years on, they don't like you anymore. Goodbye. You'll take it. I can give you some real terrible examples. The only people who can really take value from you and destroy you are government. As somebody said the other day, they have nuclear weapons, and they definitely have bigger weapons than I do. And the reality is that is a big deal. So it's a really exciting world, which is why you can't forget about the fact that we've got data and geopolitics as a big deal. But that said, I am really very constructive about the markets going forward, especially for the next 5 years. I'm not sure about the next 50, but definitely for the next 5.
Before we leave the ESG topic, Mark, you mentioned that you have a good example of how you use ESG principles to make better credit judgments. So would you share that with us?
Yeah, I mentioned to Allison last night at the Goldman cocktail party. He was nice enough to be invited to. that besides macro standpoints for ESG looking forward many years in disruptive technologies and industries, that we're finding as an early adopter of ESG and using those tenets as part of our credit process has been very instructive to keep us, allow us to make some very sound investments as you look at sustainable companies and keep us out of difficult investments that, in fact, in one case in the UK went to administration where an ESG principle kicked us out or prevented us from making the investment and we were saved. So interestingly, for example, we looked at a supply chain in the United States in an herbal extract company where the workers were getting bitten by rattlesnakes, the ecosystem was being disrupted from the plants that were being harvested. We didn't make that investment. We did, interestingly, make we diligenced a supply chain in China for pet food that was getting sold in the United Kingdom, and that held up, and that investment's performed very well. And so we found that even on the ground, or day-to-day, I should say, using ESG principles as part of our credit process has been very fruitful.
So we've covered a lot of ground on the current state of the markets, and I'd like to ask each of our panelists short answers, 3 short answer questions. So the first question, and we'll start with you, Joe. What is the biggest risk to the health of the global economy and capital markets right now, in your view? Short answer.
Short answer. Short answer is, I think we're watching from a macro top-down perspective. I think probably the U.S. dollar, which is up about 9% in the last year. Oil's, sort of getting into the mid-70s. So, things that will change this Goldilocks environment where you have, we're watching this. It's a race between the central banks and slower growth. The central banks right now are winning, and things that will change that could change the macro environment. But right now, the bottom up looks okay.
Okay, Mark.
Isolationism in all of its forms.
Okay, that was a great short answer and very short. Okay, Michael.
Energy. Look, oil is about 3.5% of global GDP. The other energy pieces are about 2%. That price changes will actually change the world. But if you really want to know what keeps me awake at night is the pandemic issue. That'll destroy the world. If you look at what happened when SARS hit, there were only 37 people died. The reality is that knocked the global GDP down by about 3 to 4% pretty much overnight. So that's something that will actually take us to the cleaners.
Okay, Elif.
Low interest rates, it allows for mispricing of risk.
Okay, Mark.
So I'd like to point to slide 6. I don't know if we have an ability to put that up.
Are we allowed short answers, have
But,
slides?
okay, well, it's a demonstration of the growth of the stock market in the United States and the wage growth, and you see a huge outperformance for how stocks have grown and wages have stayed relatively flat while growing. So the good news is that keeps inflation down. The bad news is it's created all kinds of divides in this country that may be irreparable if they're not changed soon. And maybe, again, this is a US-centric view, but is previously the global leader of the free world, that we can't even manage to agree in our own country on how to run things, I think portends problems for the future from a social standpoint.
Can I tell you something? I'm not a US citizen here, by any stretch of the imagination. The fact that the US dollar, if you look at the global purchasing power parity, is 125 trillion. In US dollars, it's 80 trillion. A dollar in the US buys a dollar outside the US buys $1.50. I'm not surprised that you've got those disparities inside the US. I mean, but the good news is for the US is it's somewhat contained. But I mean, the reality is that that Gini coefficient is a big deal, which is, I think, what's being talked to. But the macro reason why that's happening, it doesn't surprise me one iota.
Okay, second short answer question, Joe. What will be the best performing asset class a year from now when we're sitting here?
So I would think the best way to answer that is based on how we're positioned in our flagship fund. Our biggest allocation is in distressed.
Okay, seeing as I was so short last time, I will digress for a minute.
Okay.
I was going to say that these one-word answers reminds me of the anecdote of when Boris Yeltsin was once asked to comment on the state of the Russian economy, and he was normally typically incredibly verbose. So they said, please, President Yeltsin, just give me one-word answer. So he said, good. And then he was asked, well, could you expand on that a little? And he said, not good. So, anyway. So, one-word answer. I'm also going to digress because we're a long-term investor. I'm going to give a long-term view, 10-year view, and I think private equity is probably going to be the best performer over the next 5 to 10 years.
Okay. Michael?
Credit in the short term, especially structured credit over 2 to 3 year cycle.
Okay, Elif?
Given the low interest rates, equities, I think.
Public equities.
Public equities in general, but
Okay.
public as well.
Mark?
There's almost $1 trillion of BBB minus bonds that could get downgraded and fall into, opportunistic distress trading categories, and that's what we're looking at.
Okay. So last question. We all read a lot. Let's say I woke up in 2019, had no idea what was going on in the world. What piece of literature could I read that best explains the current environment? Joe?
So, hands down, because I follow it obsessively, is Twitter.
Twitter. Okay.
Historical literature as well was the interpretation. I love Twitter, but historical literature, waiting for Godot, waiting for the rise of inflation.
Okay.
Samuel Beckett has a lot to answer for. That's a terribly boring play, Waiting for Godot. But leaving that aside, Henry Kissinger's book on world order, that is published in 2014. I think that one where he talks about the change in the Westphalian order, that is a really book which is really worth reading. Henry Kissinger is really off the charts. He's great.
Okay. Elif?
I'll answer in terms of a book. It's AI Superpowers by Kai Fu Lee, and I think we're very lucky to have him here because he not only talks about the importance of AI and data, but also the differences of approaches of China and the US to that topic.
Okay. And Mark?
I like a book, Sapiens. It's a history of humankind. Gives you a perspective on how we all think and behave, but I would defer looking forward to an AI book on learning how we all behave.
Okay, great. Well, can everyone please join me in thanking our panelists for a great discussion?
I love your insight.